So this is how you can make either your own notes or you can use these ones. I would prefer that you make your own, so will help you better understand. So I'll start with the economic section here. It is when it comes to the monetary policy, it should come into your mind that Federal Reserve Bank is the one who is going to set the monetary policy. When they want to expand economy, they want to increase money supply, and how they can increase money supply, they have to buy security so they can put money into the hands of people. And what else they can use to expand economy is that they're going to reduce the required reserve ratio, and they're going to reduce the discount rate, they're going to reduce interest rate. So this all relates to the monetary policy that going with Federal Reserve Bank or the central bank, that you can say it. When it comes to the fiscal policy, then that is a place where government is involved. What government can do, they can either increase spending or decrease taxes to expand economy. And then opposite will be true for contraction. When there is a contraction required in economy, then government has to reduce spending and increase taxes. And same goes with the monetary policy. When they want to contract economy, they have to reduce money supply, they have to sell securities, they have to increase all these three ratios. So you can have multiple questions from this area specifically. They can confuse you. They can say you that fiscal policy, under fiscal policy, what government can do, they can increase reserve ratio or they can reduce reserve ratio. So you should be very clear that fiscal policy and government, fiscal policy goes with the government, and government can do either increase spending or reduce taxes. So this part is with the Federal Reserve Bank. So they are the ones who are going to deal with this part. That is a monetary policy. So government has nothing to do with the monetary policy, and bank has nothing to do with the fiscal policy. So be very clear about it. There can be any question about it when it comes to expansionary or contractionary. So write this statement. So this is the page, the first page that I'm sharing with you. This was the page that I wrote it within the first 10 minutes that we have when we start paper. So I just copied this page on the top of my sheet that we get in exam. So this was helpful answering multiple choice question and solving other questions. So you can write this one statement, and the other will be true when it comes to the contraction. And if you have time, you can write contractionary economy under it and then make the statement opposite to it. But be very clear how to read it. Then it comes to elasticity. So when it comes to elasticity, when the demand is elastic, how price and total revenue are related. They can give you multiple questions. They can tell you if price increases, what happens to the total revenue? Price decreases, what happens to the total revenue? So when the demand is elastic, they're inversely related. Price and total revenue are inversely related. It means that when price increases, total revenue will decrease. When the demand is elastic. When demand is inelastic, price and total revenue are directly related. Price increases, total revenue increases. And obviously, when it is unit elastic, they might ask you about unit elastic. It is there is no change. So total revenue and price does not change. So there is no change when the price increases, total revenue remains same. So there is no a change. It increases. That is a unit elasticity. So when it comes to elastic or inelastic demand, price and total revenue, be very clear about it. It is elastic when it is inversely related. Inelastic is directly related. So don't get confused that inelastic is inversely related. So don't get confused. So be clear about this part as well. Okay, so now let's talk about the equilibrium quantity. So this was confusing for me initially understanding it. So that's why I made these notes so I can put it on my paper and solve it as I go along. So how you can make your own in the exam quickly. So this is demand, the first column, this is supply, this is equilibrium quantity, and this is price. So they can ask you many questions about it. When demand is increasing, supply is increasing, it means that demand curve shifting right, supply shifting right. So when they're increasing, equilibrium quantity will increase. There will be the price cannot be determined. So you can make it like I together, D. So it's easy to make. So you can make 3 I's in the first, then D. So it's decreasing. Then demand and price. Remember, I and price goes the same way. Demand column, and same D and D. These last three goes same way. So this is increasing, this is decreasing, this is decreasing, this is increasing. And then rest all are indeterminate. So you cannot determine those. So this is the column. It takes like a minute or maybe less than a minute to make. So you can make this on your exam day and it will help you answer many questions. So they can ask you the question, if demand is increasing, supply is increasing, what will how the equilibrium quantity will be impacted or price will be impacted. Any question can be answered, so you can very clearly answer this question. Let's say someone asks you, this demand is increasing and supply is decreasing, how equilibrium quantity or price will change. So you cannot determine the impact on equilibrium quantity, price will increase. So any question can be answered using this table. So know how to read this table, understand it. This is given in the book, so I just made it a shortcut so I can use it in the exam. Also, this chart I found very helpful writing on the exam sheet. This one is how I can use this equilibrium quantity chart. So make sure that ceiling, they ask you many questions about it too. Ceiling is the maximum price below equilibrium. So we get confused looking at the word ceiling. It tells you that maybe it's above equilibrium. So make sure that ceiling is a price that is below equilibrium. It's a maximum price, not the minimum price. It's a maximum price set by the government. When it comes to the ceiling, remember that it is about the rent control. And this is the situation. So this is our supplied quantity supplied here, and quantity demanded is here, quantity supplied is, this is our quantity supplied. So you can look at it, where is our quantity demanded? Quantity demand is here, it is more than supplied. Why? Because there is more people are demanding. There's a price that is set below equilibrium. Because this price is below equilibrium, there is more quantity demanded than supplied. So at this point, quantity demanded will be more than quantity supplied. So there can be any question that below equilibrium, is it ceiling? Is it a minimum price or a maximum price? A quantity demanded more than quantity supplied or less than quantity supplied? Is it a shortage or it is a surplus? So you should be very clear about these terms and these things, where comes when, what comes where. Similarly, it's a top part. If there is a surplus, it's a floor, it's a minimum price, it's above equilibrium. So you should know this is a position when quantity supplied is more than quantity demanded. Okay, so because there is a minimum price set above the equilibrium price, more price is set, higher price is set, more people are available to work, but quantity demanded is less. Okay, so know these things. There can be many questions from here, and it can be asked in any way. So you should be very clear about the concept. Rest is very clear. So this is about the flexible budget, how the fixed it was a fixed cost variance, yes. So you can see this was a little confusing, so I put that on my paper too. So the difference between actual and static budget, you can say it, or you can say the budgeted plan, whatever is the actual budget set at the beginning of the year. So difference between those two is the spending variance. Flexible budget, how you calculate it, you take the actual production, you take at standard hours and standard rate. So this is standard hours, standard rate, and it's a budgeted production. So that's how you can calculate the budgeted static budget. The difference between flexible budget and static budget, that gives you volume variance. Difference between actual and flexible budget gives you flexible budget variance, and actual and static gives you spending variance. So this part was a little confusing for me in understanding, so I put that on too. So this is a formula for annuity, how you convert ordinary into due and due into ordinary. So it's self-explanatory. So you can go through that. I also put this formula of detailed dew point analysis, the detailed one, so I can use any question that is asked and I can break it down easily. So this is also, you can write it on. Also, how inflation, what happens when there is inflationary economy, monetary assets is bad for the monetary assets, it's good for the monetary liabilities. You can put that in your cheat sheet if you want to put. Means that the 5-10 minutes that you have before the exam. So I also put this equivalent unit formula that if you're using FIFO, you have to use beginning, the percentage to be completed. So make sure that this is a percentage to be completed, not the one that is already done. That is given, the percentage that is given in the question is already done. So you need to take opposite. If 40% is completed, you're going to take 60%. Then completed minus beginning, and then ending percentage. So just write down this formula, go over it, and then this is how you can calculate the equivalent unit. And then when you calculate the cost, you're going to take only current cost for the FIFO. But for weighted average, you're taking current and beginning, both. So there are 2 items for beginning to calculate equivalent unit. There are 2 items to calculate cost. beginning plus current, and then you divide by the equivalent unit. So this is what helped me going through. Also, this question helped me in answering multiple choice question as well as long question. It can help you. Someone might ask you in the long question, what is the difference between short-term and long-term financing, or the company wants to pursue short-term or long-term. You suggest the company which way they should go. So you should be very clear about what is the difference between short-term financing and long-term financing and how they're different. So it's you can either read it or you can make your own notes as you go along. One important thing that I want to go over, yes, lease and buy. So when there is come to the lease and buy decision, that is a point where we take all the costs from beginning to the end of the asset's life. So what are our inflows and outflows? So we compare our inflow versus outflow. What is the net inflow and outflow? And then we are going to compare if the project is, which one is beneficial, buy or lease. So lease one is easy. So you just have to take lease payments. You're going to subtract tax saving on lease payments. Okay, so how you can calculate that? Lease payments, after tax lease payments you're going to take, and then you're going to multiply with the PV factor. So you're going to take the payments, whatever the lease payments are given, it's 1 minus tax times PV factor. That will give you the net cost of the lease. Okay, and then buy, when you're going to buy, what are the costs involved? There is a purchase cost or the present value of lease payment after tax. So that goes to the lease part. But here it involves, when you're buying, is a purchase cost, and then you take depreciation tax sheet and then the scrap proceed. When you're doing NPV, regular NPV, you're not taking this depreciation shield and scrap proceed at the time of inception or beginning of the outflow. You're not considering those. These are the costs that you only take when you're making buy versus lease decision. Then you take what happened over the life of the asset, but not in the regular NPV calculations. I'll go quickly over that as well. Okay, so this is how you can see purchase cost minus depreciation shield here times the present value factor. Then you take it the scrap value times the present value factor, and this gives you the net cost, what you're going to buy. And then you compare those, what is the next, either buying is beneficial or the lease is beneficial. Then you compare it with the inflows, and you get the net present value of the project. So how you can get the inflows? Inflows, you calculate what is the after tax operating cash flow. So let's say you have earning given. So make sure you're not taking the full amount of the earning, all the net income that is given, you're not taking that. So make sure you're taking it after tax. Okay, so after tax, and then you discount it as using the WACC. Okay, weighted average cost of capital. When you discount the factor that you use for financing, buying or lease decision, you take after tax cost of the debt. Let's say you're giving the interest rate of 10%, and then if you're given the 30% rate of tax, your cost of debt is 7%. Okay, so you're taking after tax cost of debt, not the 10% the rate of interest that is given to you. So make sure you take the proper rate when you calculate this lease versus buy decision. For inflows of the cash, you're taking WACC. So make sure you understand that how you're calculating lease versus buy. When it comes to the net present value, so these are the stages of the cash flow. You should be very clear about it. The first stage is at the inception. So when they can ask you many questions, they can ask you a question about just this stage, about inception, what happened when you're purchasing an asset, their purchase price is involved, all shipping, handling, installation is included in that. If there is any requirement that say there is this much of the increase in working capital required, that will be included in the purchase price. And also disposal. If there is any old asset that you're going to dispose of, you have to take after tax price of that disposal value. That is all the inception price. So let's say you bought an asset for 50,000, you're required to have increase in working capital for 10,000. So 50 plus 10, 60,000. Then you sold your old asset for 10,000. Your tax rate was 40%, so 4,000 was tax. After tax, you had 6,000 of proceeds. So 60,000 minus 6,000, because disposal gives you inflow. So that is going to reduce your initial cost. Okay, so make sure you subtract that. So purchase price plus increase in working capital minus the net of tax disposal value, that is the initial outflow. You can be asked this question in any multiple choice question. Then if they ask you the net present value, then you have to look for these inflows. What are the inflows? There can be one inflow, that is operations. What are you doing during the year all the profits that you're earning, your depreciation shield, you take that, and then one time the terminal year when you dispose of this asset, that is the inflow. Make sure you're taking it net of tax. So you compare these inflows versus outflow. That gives you the sum of the present value of the future cash flows. You subtract those from outflow, and that gives you the net present value. So you can see if that is that project you should pursue or not. So this is how you can compare an NPV project. Hope this was helpful.